Good afternoon, everyone. Hope everyone is having a great time. So now is the time to talk about some dollars. In 2015, the M&A volume was 8,000 transactions with $600 billion just in the tech industry alone, globally. And you have your company, you're all, I saw the raise of hands, many are founders in the audience, and you work day and night to get your company ready. And today we are talking about what is the best way to position your company to get bought and get the valuation that you desire to get the valuation. And with me, I have two highly seasoned executives, Lak Ananth and Yoav Samit, and they have tremendous experience and expertise in the corporate mergers and acquisitions and also corporate investing. So I'm very glad to have them here, and let's dive in. Thank you, Yoav, and thank you, Lak. First of all, let's start with your brief background. Do you want to go, Yoav?
Sure. My name is Yoav Samit. Until recently, I was Vice President of Corporate Development at Cisco, running corporate development support for about a third of the company. At Cisco, corporate development covers everything that is equity related. So it's both the M&A arm as well as the venture arm of the company. One note to clarify, I'm no longer a Cisco employee, so I will, look at that. I'm no longer a Cisco employee, so I'm not speaking on behalf of Cisco or officially as a Cisco employee, but the upside from that, I guess, is that I can be absolutely objective in my answers to you.
Great. Lak.
Yeah. Hi, everybody. I'm Lak. I run a group inside Hewlett Packard Enterprise called Pathfinder, which does venture investing, partnerships, and M&A strategy. And I've started this group, and I've been running it for the last couple of years. Before that, I ran corporate development, regular M&A, and then venture investing for the enterprise part of HP then, which has now become Hewlett Packard Enterprise. And before that, I spent many years at Cisco working with Yoav and many others. And then I also was a venture investor before that, and worked with the previous panelists, Ravi and Naveen, and many of those. Yeah.
Awesome. So, how do you think about build versus buy? When do you build a technology or a business within your companies, and when do you decide to go buy that expertise? Do you want to start off, Lak?
Yeah. So you think about it differently. Whether if you're wanting to enter a new business, obviously, then you start with, if you have some underlying technology, but you need to enter the business at scale, then you would start with a buy first kind of approach. But a vast majority of what we do is not entering new businesses, but just looking for things that are adjacent or things that can accelerate product roadmaps and core. The point at which you get to a buy decision is generally when you are aware of the market, maybe you have an internal effort headed that way, but it's not going as fast as you want, and the market's moving faster. So generally, as you see the market moving faster, you see proof points of that, and you want to accelerate where you're headed. That's when the buy part of it kind of becomes predominant, and that's kind of been my experience at Hewlett Packard and also before that.
Got it.
I'd say at Cisco we looked at it not just as a build versus buy, but we called it build versus buy versus partner versus invest. Kind of a little more colors to the spectrum. For us to engage in a buy decision, oftentimes it's a balancing of arguments across time to market, OpEx availability, and overall prioritization of future roadmap for a specific business unit. So there are a set of priorities that the business unit sets as it trajects to the future. Some of it can be delivered internally in time. Some of it cannot. Market pressures and competitive pressures often accelerate your need to harness capabilities that you're unable to develop internally. And those create pressures for inorganic growth. When you move to that inorganic kind of dimension, it's not necessarily that you have to own everything. Sometimes you can achieve those objectives by partnering. But if it is so core to a strategy that it needs to be owned, then that's when we move to a buy decision.
Got it. So I want to touch a little on the competition front. We see these cohorts of acquisitions happening every now and then. Marketing automation got consolidated 2 years ago, and human capital management software got consolidated, and software-defined networking was in that realm a few years ago. So how does that play into, for example, if Cisco acquires a storage company, would Dell be pressed to acquire? How does that dynamic come into play when you're looking at a candidate?
So when a market leader makes a move into a certain space, sometimes it instigates a certain kind of tornado, and other competitors start acquiring in that same space as well. At least at Cisco, we tried to be ahead of that curve as much as we could. Nobody likes to be thrusted into a competitive situation. A competitive situation is not good for the buyer. It's good for you guys. So we try to preempt that as much as possible. But those trends and tornadoes do ensue sometimes. Yes.
Got it.
I echo a lot of that. What happens is that the point at which the market becomes real and there are one or two companies emerging, acquirers, every buyer is kind of looking at it from a slightly different lens, but fundamentally they're matching where's the business opportunity, where am I internally, and where's my competition going, right? So they're kind of evaluating, and if something really matters to their customers, then you have to kind of figure out, and generally you're better off being the first, knowing a space really well and being the first acquirer, because you will get the best asset. That's how, as a buyer, you tend to think. You don't want to be reacting to somebody else doing something, or you don't want to be the person that goes in and buys the third best asset in the market. That's how buyers think.
Got it. So what I'm hearing is you want to be the first mover. Stay ahead of the curve.
Absolutely.
And so I'm also hearing that you would like to acquire number one, or maybe if that's acquired, number two player. And would you ever acquire a smaller company if number three, number four ever, or that's kind of, you want to build at that point?
So maybe I can start on that. I think first we need to kind of double click on the types of acquisitions, at least that Cisco did. I guess I could characterize them into three buckets. One would be really small, what we call talent acquisitions. Other companies call them acqui-hires. The second category would be product acquisitions, companies that already have a product, perhaps initial sales, sometimes pre-revenue. The third category would be platform deals. Mm-hmm. Those are the big, multi-billion-dollar moves into new categories. Certainly in the platform category, we always like to go after the number one, number two position.
Okay.
In the smaller categories, it's not as critical, and that's where the fit of the talent, the technology architecture are relatively more important than other aspects, and you can compensate for that if you execute well after you integrate the company.
Okay.
It's I'll speak of some of the opportunities that we see as a buyer. Sometimes we have companies that come to us and say, our technology is not quite baked, we don't quite know how to sell, but the beauty of it is you guys have infinite resources, you have a great go-to-market. If only we could join forces with you, things would be a lot better. And so I think that kind of argument is very hard for a buyer.
That's a lot better for whom?
Yes, of course, better for who, but that's very difficult for a buyer because we are using acquisitions as a mechanism to solve the innovation problem, to solve a market opportunity problem, and we don't want to acquire more problems that we have internally.
Right.
So I think that's why, from a startup founder perspective, I would say those arguments are hard to kind of get through.
So in other words, you're saying go figure out where is the business opportunity, try to sell, be successful, and then come to us with a clear pitch as to why your product,
right? And a great product. And so it's all the things that make a company successful as an entrepreneur, for a venture investor, for a founder, or all the same reasons why a buyer would be interested.
Correct. So switching gears a little bit, how do you plan for your acquisitions? Do you have a list that you go through, 1 to 100? Or do you just do on an opportunistic basis when somebody puts you a call, whether it be VCs or bankers, or how do you do it?
What we don't, I think what doesn't work with buyers is just inbounds. I think most buyers will deal with inbounds and they will think about it and they will see it as a way to just keep abreast of the market. So if you're a founder and you hear somebody telling you, look, I'm a banker, or I know the 5 people in corporate development, let me, give me a mandate, I'll sell your company, I think I wouldn't recommend going down that path, because we don't approach, most buyers, at least the great buyer, you won't get a great price or a great outcome. Most good buyers don't approach it that way. We generally we can talk about it a little bit more, but the good buyers, I think, both from a business perspective as well as corporate development, keep an eye on the market. They get to know everybody in their patch of the woods. There's usually some kind of coverage model inside in the organization that says, I'm looking at this market and that market and that market, and you collaborate with the business unit. So there are priorities that come through the interaction of what's happening in the market and what's happening in the business unit, and that's how these acquisition ideas are hatched. We broadly say, okay, these are our growth areas for the company. This is where we're going to acquire. But it's not like maybe there's generally an idea of like a universe of 50, 60 ideas that kind of exist, and some of them could become timely, but it's not like there's a secret black book with like 5 things that are executed one after the other.
Okay.
Just to give you a little bit visibility how it works at Cisco. So the Cisco Corporate Development Group, just the deal-making group, is about 45 people, 2/3 in the US, about 1/3 outside of the US. And to Locke's point, subdivided into either domain or geographic expertise. And so each domain-specific or geo-specific team is chartered with knowing everything and everybody that's active, that's relevant to Cisco and active in that sector. For us, it's definitely about keeping tabs. I'm still saying us, but for Cisco, it's still about keeping tabs on the market and getting to know the players. And through that relationship, it's an evolutionary relationship. It's not about a pitch. It's not about, let's prepare a pitch, and there is this singular event where there is a pitch, and after that pitch, everything happens. It's a process, and it requires patience. And a long-term view on the relationship between any of your companies and any big potential acquirer.
Got it. So, Lak, I want to touch on the point that you raised before, where if a founder or an entrepreneur puts a call into you saying, I want to sell my company, you almost said that that's viewed less favorably than you going after.
If I were a founder, I would call somebody I would try to build a relationship. Just like many founders know how to do fundraising. I think it's a similar process of kind of building relationships, building trust that eventually leads to something.
Okay.
And it's not just about going and having a pitch. Coming into a buyer and saying, we love these inbounds where people say, well, we run a process and we have an LOI that we need in 3 weeks. And we've never seen the company before. And it's like, okay. It never happens.
Right.
Yeah, I'd like to echo that. So to develop a relationship with a big corporate, to do it through a banker is not necessarily the advisable first step to that relationship. When a corporate development apparatus gets an inbound from a banker, there's already a kind of a flag up. And if it's a short-term process where we have never seen the company before, there is slim chances that it would go anywhere. Again, the best way to develop that relationship is gradually, just like you would develop it with a partner. You find a way to get introduced to the right people, either in the business or in corporate development. By the way, it doesn't necessarily have to happen through corporate development. A lot of the times, actually developing a good rapport with the respective business can then lead to a corporate development interaction and actually adds credibility to you in that process.
I agree.
So I have two follow-up questions here on that thought. What is the right time in the life cycle stage for a founder or a CEO to start developing those relationships with you? Because if there is one thing that they need to optimize, that's the resources that they have, that's the time that they have. And the second one is, there is also this view about large companies trying to get smart or trying to know what the smaller companies are doing, and they could do it themselves internally. So how do you balance that?
One thing I just want to put out there, because I think it's very important for founders and CEOs to know, it is extremely difficult for a big company to mobilize resources ad hoc for some purpose. So I sometimes met entrepreneurs who would come in and they would be very hesitant about kind of disclosing what they're doing, or kind of afraid, oh, Cisco or Microsoft or HP or Apple or Google, whoever, well, put 200 engineers and do what I do like in a month.
Right.
There's no company that can mobilize 200 engineers that easily. Every company, every big company is OpEx constrained. Everybody is fighting for resources. Nobody has resources. They're already locked into their roadmap. Oftentimes infested with bureaucracy and process. So a well-executing small startup has a huge advantage over any big company in terms of ability to develop and move quickly in the market. The key word is execution. Yeah, you do need to know how to execute. In terms of stage of approach, it's different for different companies. At Cisco, it's not necessarily about an M&A event. As I said, it's a spectrum. It goes from investment to partner to kind of buy to invest to partner to acquire. Sometimes an investment by a corporate investor is a good early kind of entry or early enabler into developing a relationship, which can then lead to other more strategic kind of activities between the companies.
Okay.
Yeah, I think your original question was when would you, so I think the short answer to that is when you have a product and you have your first 10 customers. So that's when I think you should start, just like you would with your customers, similar time, start to build some relationships inside of the right corporates that are in your zone, because that might lead to investment opportunities, partnership opportunities, would naturally lead to acquisition opportunities at the right time. If there's very little to show for other than the PowerPoint, then that's not a great time to be building relationships. And I would be very consistent, and I would not, it's like put yourself on the radar when you have the product on the first 10 customers. Not burn too much time on it, but
right.
Just kind of keep that consistency and build relationships with 3, 4, 5 different corporates, not just one.
Got it. So we talked about how startups can build relationships with companies like you, but how about you proactively reaching out to a company? We hear this term, we received an inbound offer, or we received an inbound call from founders and entrepreneurs all the time. So first question is, when do you take that step? What triggers you to take that step? And so how serious you are at that point? And follow up to that is, how can founders and CEOs know that it's a good use of their time to entertain such requests? Because there are certain fishing expeditions that some people tend to do, some companies tend to do.
Let's perhaps differentiate between understand what requests are. I mean, if it's an offer, then once you get an offer from a venerable big corporate, it's serious. It's not a fishing expedition. But sometimes, definitely, there are proactive reach outs to companies to come in and introduce yourselves to a corporate. As I mentioned, at Cisco, there were a number of domain-specific or geo-specific teams that were chartered with canvassing certain sectors. And if, as part of that process, they identified you as somebody who would be great to put on the radar, I think it would be a good thing to come in and definitely entertain a meeting. At the very least, it gives you the contacts to go and engage with later on. Where I would advise to be careful of kind of use of your time is if you engage, say, with a business entity or business unit within the group, and they start asking you to do things, to expense resources, or to start doing some customizations or dedicated work. That's when you need to really weigh the benefit versus the weight of the effort.
At Hewlett-Packard Enterprise, I think our thinking has evolved on this quite a bit over time, and we've separated the front end of getting to know the ecosystem, investing and partnering from the actual M&A activity. So that I think we want to build relationships and develop relationships with the company, and this goes all the way up to the top of the organization. I started Pathfinder 2 years ago, and one of the first things I did was say every month I bring in 3 of the companies that we really like that could be of interest to Hewlett-Packard Enterprise, and we do something called Coffee with Meg, where we have the 3 founders with Meg and all of the executive team of Hewlett-Packard Enterprise. And so if you receive that invitation, hopefully you will accept it. But it's we think, we take innovation and getting to know companies very seriously. And as Yoav said at the beginning, you could have any number of outcomes in terms of partnerships, but we kind of take getting to know the ecosystem very seriously. Just like a couple of weeks ago, Naveen was there in that Coffee with Meg with 3 of his startups. We've had really good relationships and conversations evolve out of getting to know companies, and it doesn't have to be like there's an acquisition conference. Just because you met with Meg doesn't mean an offer is going to show up the next day. Right. It's kind of it's a very productive engagement.
Got it. So let's touch on what makes a company an attractive acquisition opportunity for you. Is it the business model? Is it the financials, revenue or profit? Or is it the product, or is it the people? I think the answer is a combination, but how do you think about it? And how can the founders here think about managing their businesses to make sure that they are attractive to acquirers like you?
Obviously it's a combination, and it's also stage or size dependent. As I mentioned, there are these 3 categories of acquisitions that Cisco has done. Clearly, the smaller or the more earlier stage the company, the more it is about the talent and the technology versus revenue, momentum, or margins at that point. The larger the company, the more it becomes what we call the platform acquisition, definitely the multi-billion-dollar companies that are already on triple-digit revenue run rates. Then there is extreme scrutiny to growth, to financials, and to margins. Irrespective of the stage, though, a corporate development group that prepares for an acquisition will always create a DCF analysis. They always do a discounted cash flow analysis, translating all the hype and the words and the PowerPoints into a set of assumptions that boil down to a net present value of your company. And that analysis also will inform a certain ceiling or bracket to what can be the size of the acquisition. And it's just that the assumptions that you inject into that analysis are much more rooted in fact when it's based on actual execution versus when the company is really early stage and it's just based on an outlook to the future.
Got it. So Lav, can you touch on some of the business metrics that you look at? We are talking a lot about growth versus profitability and sustainability in the business model. And how do you look at, are there any kind of red flags that you see that people should know about?
Well, I think different kinds of buyers. I think the larger the buyer, I would say it all boils down to, are you hurting that buyer with a customer? Mm-hmm. Or a set of customers that mean a lot to that particular buyer, very interested in you, in your technology, and irrespective of stage, if you're getting very relevant to a buyer, you're getting revenue, and you're playing in a core market to the buyer, then that's always the best thing that drives value, because then that shows that you've really got product market fit, you have a forward-looking roadmap, and hopefully you have the revenue metrics to kind of follow that. So I think that drives the initial interest and into a very large buyer. On the other hand, if you're selling to a new emerging company, they may be more focused on the technology. And I think we will do a lot of technology diligence. A large buyer will do a lot of technology diligence. We'll think about the forward roadmap, but the customer relevance and kind of how it fits into where we want to go becomes a big factor. In terms of metrics or red flags, going back to what Yoav said, you have to remember that a buying is a process. It's not like a one meeting and a transactional thing. The biggest red flags I've seen are inconsistencies. So when you have a first meeting and a second meeting and you say, I have 10 customers, you say 5 are referenceable, I have 5 million in revenue, when you look at the book it's 2, those kinds of inconsistencies will always come through in the buying process, especially when you've got to remember, as a founder, you're dealing with a sophisticated buyer who does many, many transactions, and they've seen the movie, and the people have seen the movie many times over. So I would say being upfront and consistent and matter of fact would really help you. And being the red flag tends to be those kinds of things. The one last thing in terms of business metrics, it's always hard for a large buyer to take on huge amounts of burn. So I think in the last 3 or 4 years, I think we haven't necessarily built the most capital efficient companies in the world. And I've seen quite a bit has changed in the last 6 months, where every board meeting or investee companies that we've been to, it's all about cash and burn. OpEx, like balance sheet dollars, big companies can afford it. OpEx, hard. So high burn, I think, is hard for a big acquirer.
Got it.
Yeah, that OpEx point on OpEx is extremely important. People are not aware of it. It's easier to do the one-time balance sheet expense. Assuming OpEx is extremely hard for big companies.
Got it. So let's touch on. Sorry.
Oh, we're out of time?
All done? Okay. So let's touch on this people point. Okay. How important is the dynamic of the founder or the CEO for you that they need to get along with your executives for a potential transaction to happen?
Extremely important. So people alignment is extremely important. The leadership, I mean, every acquisition at the Cisco process at least has the identification of key employees. Typically the founder, CEO, CTO, and a few other leaders are identified as key employees in the company. It needs to be maximum alignment between those coming in and the kind of acquiring or assuming group. Without that alignment, or lack of alignment is a deal killer, actually.
Got it.
And I think people, it's kind of like, in Silicon Valley, it's kind of like, oh, you have a 2-year retention, and the day after that, you're out the door, right? Everybody's planning for that. I would say that it's some of the best acquisitions that I worked with, and the founders and the CEOs. And the reason the big companies want founders and CEOs and CTOs to stay is if they stay, then the team stays, and you're really buying the future roadmap. And if the team leaves, then you're not getting the roadmap, right? But I've seen, I think, being very clear about what as a founder or as a CEO of a startup, what you would like to do is actually good. I think it gives confidence to the buyer to probably pay more or be more confident about the transaction and you following through. And it's not, I mean, I think most acquirers are also pretty savvy to the extent that they want founders and CEOs. I mean, nobody stays forever. But they want that kind of, like, they're buying the company because of it's a good culture fit, the people are going to stay and make it happen. Remember, I mean, people are paying for the future value the company is going to create.
Right. So we are out of time here, but to summarize here, I think 4 important points that our fantastic panelists have raised is develop a relationship with the companies that you are interested, that you think your company could be a good acquisition target for. And it's not a one-time transaction that happens, it's a process. It's a long process. Third one is, you should have product right, there should be consistency in your business model and your business metrics. And the third one, and the last but not the least, is the people aspect. They are paying for the future value, and they would love to have you develop a relationship so there can be a good dialogue between the acquirer and the target, not just through the process, but after the acquisition happens. With that, thank you very much, Yoav and Lak, for your time today.
Okay, thank you.